Good evening, everyone. We're going to get started as we continue to have attendees join us. My name is Samantha Putnam, and I'm the Executive Director of the Alumni Association at UC Santa Barbara. And we are thrilled to be able to offer this webinar this evening as part of our Gaucho Academy series. American Pacific Mortgage are our sponsors for this series for Gaucho Academy, and we're incredibly grateful to have them support us this evening with this webinar to bring to you more information about being a homeowner. Our partnership with American Pacific Mortgage is really a strategic partnership for us so that we can continue to bring benefits and opportunities to our alumni. And I think, as we all think about navigating the home buying market, it's incredibly complicated. Things are changing really quickly. And so we're very hopeful and that, this evening's webinar is going to give you some support from some experts that will help you with that process. I'm very grateful to Jason and our friend Ken on the line here today who are going to help us. And so without further ado, I will hand over to Jason Mata. Thank you so much for joining us this evening.
Awesome. Thanks so much, Samantha. It's great to be with everyone this evening. So excited to bring this content to everyone. This is our first virtual workshop for the UCSB alumni group, and couldn't be more thrilled to bring it to you tonight. And as Samantha mentioned, we are a strategic partner with UCSB Alumni. We're really excited to launch into this first workshop for you as part of your Gaucho Academy and financial awareness. And, mortgage and home buying, there's lots of stuff that goes on with that, and especially in today's market where things are just a little bit different, right? And so I think where these classes that we provide across the country through our strategic partnerships really add more resources and support to really better understand how to navigate this complicated, really home market. So tonight's session is going to be about an hour. It's a very interactive session. We encourage questions as we roll through tonight's content. I would encourage you to use the chat function on your Zoom, and then myself as well as my colleague Ken will help answer some of the questions on air. And a lot of those questions that you probably have, or many of your fellow students in tonight's class probably have the same questions. But we do try to make this content very interactive as we roll through our session. And then in tonight's session, all of our material, we are going to record tonight's class, and we also will provide all of tonight's content out to you via email tomorrow morning. As I mentioned earlier, we are a strategic partner with a UCSB alum, and we're an organization that's actually a California-based organization, American Pacific Mortgage. We're out of Northern California. We are a nationwide lender. And with our particular side of the organization, we really focus on education. So we teach classes across the country, primarily on first-time home buying. So, if you enjoyed tonight's class and maybe want to encourage a friend, family, maybe even a coworker to attend a class, we teach classes like this throughout the year. So we, teach over probably 100 classes throughout the year. And now tonight's class, we're going to talk about a variety of different things in home buying, and we're going to look at the housing market. We're going to kind of spend some time looking at some data there around California. We're going to look at the interest rate market. Have some great news on the interest rate market, or maybe we'll say great, we'll say good, that we got last week. And any encouraging news we can get in interest rates is really super important right now. We're going to do a budget analysis in just a bit. We're going to look at what does it look like if I continue to rent versus what could it look like if I decide to purchase. And then from there, we're going to talk a little bit about credit, really kind of a critical piece when it comes to home buying, making sure we've kind of done a credit checkup. We're going to look at student loans and how those can potentially impact our qualifying. We're going to look at loan programs, some of the core programs that you may elect as a first-time buyer. We'll talk about documentation for a home loan, some of the assets or savings that we might need to purchase our home. And then finally, we'll wrap up tonight's class looking at kind of the process of purchasing a home and what's that process going to look like. So if I'm kind of excited about tonight's class and I'm like, hey, you know what? I want to see what this looks like for me. We can show you what that path towards home ownership looks like for you. Now, a reminder, we're going to be sharing all this information back with you. We encourage questions as we go through tonight's content. You can go ahead and use the chat function, and myself or Ken will go ahead and answer those questions on air. We have a pretty big class tonight, so we'll do our best to get to all of those questions as we roll through tonight's content. Well, let's dive in. It's a busy Wednesday night, I'm sure, for many of you. I'm probably right in between dinner time for you, so I appreciate you taking time out to listen a little bit more about this information. And when we think about home ownership, you're investing this time right now on your Wednesday night, but it's probably because it's a big financial deal for you. This is probably going to be one of the biggest financial investments you make when you decide to push forward towards home ownership. It's not like running out to the auto mall, purchasing a car. So you really want to take your time to make a good, smart financial decision. So let's think about the benefits of owning a home. Well, there's some great things that first happen with that. One is you can create affordability, especially in a high cost of living market like we're in right now. We don't have to worry about a landlord increasing rent on us on an annualized basis. We can now kind of control our destiny from a payment perspective. Homes typically will go up in value. So as homes appreciate, the difference between what I owe on my house versus what the market value is, that's called equity. And that should hopefully increase over time. Now, this is also an asset that I can kind of build with my family, right? It's an asset that I can potentially pass along to the heirs of my estate. And there's still potentially some tax benefits that come along with owning a home. So this is going to be one of the biggest investments we make in our upcoming financial futures. So we got to look at all the great things that come along with it, but we also want to buy responsibly because there's kind of two big goals that we have for our buyers when it comes to home ownership. Can we buy in an affordable fashion? But also we want to make sure this is a sustainable approach that's going to be able to help support us on a long-term basis. So let's first of all kind of dive in tonight's discussion. Let's first of all do a quick budget analysis. And it's our rent versus buying calculator. So I'm going to switch screens up and get us over to our browser here so we can kind of dive in and first talk about kind of what does it look like to budget for my home purchase. And so this is a calculator that we always kind of talk through a little bit in our workshops. And it kind of allows us to do a quick analysis to say, if I continue to rent, what is that going to look like versus what it could look like if I decide to purchase my home. So we've kind of pre-filled in some of the data for you so we can just have a quick conversation. But as I mentioned earlier, all of our presentation materials are going to be sent out to you tomorrow morning. So you'll have all the links so you can kind of do your own personal calculator. But let's kind of take a look at this and see what this might look like for us. So if we were assuming a monthly rent of $2,500 a month in rent. I know for some of you on tonight's call might say, wow, that's super low, or you might say, wow, that's super high. So you'll get a chance to adjust those accordingly. Renter's insurance assumed at $15 a month. We're going to assume also that our rent is going to go up 5% on an annualized basis. And then we have our home purchase amount. So we put in $500,000 for our home purchase. We have a minimum down payment of 3% of the sales price. Okay, so we're going to learn a little bit more about products in just a second. And again, just going back to, 500,000 may be a little bit low for wherever you're at in California. If you're in Santa Barbara, that's going to be really tough. But maybe if you're in a lower cost of living, like maybe the Central Valley or Sacramento, that might work for you. Property taxes, we generally want to assume 1.25% of the sales price when we factor into our budget. We have homeowners insurance. We have the maintenance costs of our home. So we want to factor that in. The more aged our property is, so older home, probably going to have some more potential repairs or improvements that we would have to make. And then let's think about loan information. We're going to spend a lot of time talking about loans in a little bit, but typically we're going to factor in a 30-year fixed mortgage. We have our interest rate at about 7.25. We're going to raise that just a smidge to like 7.5. We have origination charges. So when you think about financing a home, there's going to be costs that a lender is going to charge you. Those are called origination charges. Now, one of the cool things about our partnership with UCSB, we as an organization lower our origination charges by $750 to best support our clients. And then you have discount points where it gives a buyer an opportunity to be able to lower the cost of their interest rate by paying additional costs. We're going to talk about more about that in just a bit, but that's called discount points. And then we have other settlement services. Those are going to be closing costs. Generally, the total closing cost to purchase your home are going to be 2 to 3% of your sales price. Now, that's something we're going to have to budget into our total out of pocket for our home buying plan and ultimately how much we need to save. And then the last section is other assumptions. We're going to assume an appreciation rate on our new home of 4% annualized basis. Expected time that we're going to keep this house is for 7 years. We have selling costs of our home. Now in California, or generally most parts of the country, when you sell a home, you're going to be responsible for the commissions of the selling agent that represented you as an owner, as well as the buyer's agent that helped bring the buyer to purchase your home, right? So we're going to factor that in at about 10%. of course, with other ancillary costs that could be as part of the home purchase or the sale of our home. We have state and federal taxes, and then we have the savings rates. So what this calculator does is it goes in and says, okay, Jason, if you continue to pay $2,500 a month in rent, great, you can do that for the next 7 years. That's totally fine. But if you choose ownership, then you're going to bump up in monthly amount. So I have to go up to about $4,600 a month. But the opportunity for me owning versus renting is about $50,000 over the course of 7 years. Now, how did I get there? Well, I got to factor in the appreciation of my home. So my home's going up on an annualized basis, 4%. I have tax benefits that go into that number. And then when I compare that to the rental side of things, my rent is $2,500, but it's still going up 5% annually. So that's where my opportunity comes over the course of 7 years. Now, the big adjustment we have to think about is our budget, right? So we're going to have to go up over $1,900 a month. At the same time, I think it's really important for buyers to think about in today's market is the interest rates that are offered today is probably not going to be the forever loan for us. And the reason why I say that is in the housing market, in the interest rate market, things cycle. And at some point, rates will cycle down. Now, they won't get to as low levels as we saw back in 21 or 2020, but ultimately at some point there'll be an opportunity for buyers or owners to be able to refinance. And so that's where we'll see that opportunity cost probably improve whenever that owner decides to elect to refinance. Now, that shouldn't be the reason why we purchase, but it's something we should put in the calculus so we make sure that we're getting a great return on our investment to purchase a home. So that's one approach to kind of think about is a rent versus buying scenario. Now, let's talk a little bit about the housing market. I know you guys probably see a lot of different things on the news, online, what's going on with the housing market. We're starting to see some inventory pick up across the country. California specifically, we're starting to see more homes come to market. Some sellers saying, hey, you know what, maybe I do need to sell and cash out my equity because maybe I think my home's going to go down in value. As you can see on our California trends map here, we're about flat in prices. So demand's still pretty steady. Inventory is starting to kind of pick up a little bit. So, supply and demand, right? We get a little more supply, demand stays level. We could start to see maybe prices slow down a little bit, but actually we're probably going to see demand start to kick up even more because we're seeing a lot of pressure on housing for buyers trying to re-enter the market. We're going to talk about interest rates in a bit. I'll kind of tell you why, I think there's going to be more buyers entering the market, but we're projecting sales prices to go up about 5% into 2024. So, and that'll be kind of, a little bit of seasonality in the markets because traditionally in the fourth quarter, which we're in right now, we see a little slower buying behaviors, but we're actually seeing a little bit more activity for buyers looking to try to purchase before the end of the year and incur those kind of higher priced homes that we're projecting in 2024. It's interesting when we meet with clients and we look at today's rates and today's prices versus forecasted sales prices and forecasted interest rates, it almost has an equivalent payment. So if rates still come down a little bit 2024, but sales prices go up in 2024 versus today's sales prices and interest rates, the payments are almost identical. So one of the things that we're trying to coach clients is to kind of better understand your options in today's market, because I'd be more concerned about the price that I'm paying for a home versus what my actual interest rate is, because to my point earlier, we're probably going to look at refinancing at some point in time to help bring down that monthly payment. So I think it's really more important on what price point am I getting into the market on whatever particular price of home or particular home that I decide to purchase. So that's kind of one approach that we're coaching clients on right now. But at the end of the day, it's really going to be important for our buyers to have a good solid budget that's going to create affordability and, like I said, sustainability with their upcoming home purchase. Now, interest rates are a big part of the equation too, right? So, interest rates have been a hot topic, especially over the last 2 years. When you certainly compare that to what we saw in 21, where as this chart shows, we saw interest rates hit a low of about 2.6. We're a far cry from that today. We're about 7.5% or so. As we launched in tonight's class, I said, hey, we got a little bit of great news, actually no good news on interest rates. I won't say great because interest rates dropped about 0.5% on Friday. And so, some good news on interest rates usually is because we have some bad news economically. So, what we're seeing a little bit of a slowdown in the economy right now. Inflation is relatively tempered, but the Federal Reserve just last week said, hey, you know what, we're going to pause on interest rates. And so the interest rate market like that. We'll see where interest rates go. I think ultimately we've reached the peak from an interest rate standpoint. So we did touch down on 8% just 2 weeks ago, but now we're about 7.5%. So certainly an encouraging sign for our future home buyers as we look at the interest rate market. Now, the question we always get is, where are interest rates going to go next year? We really don't know. But my sense is we'll probably be in the high 6s to 7 next year in 2024. We're still a couple years away from starting to see more normalized levels of interest rates. Now, the question always is, what goes into an interest rate? Because I talked to my coworker, they got this interest rate, or my family member got this interest rate. So not all interest rates are the same for all types of, products or clients in their transactions. The market has something to do with it, but there's other characteristics like your credit eligibility, how much you decide to finance, what your down payment is. If you decide to bring down the cost of your interest rate by paying points. And so what points are is where you put additional costs out of pocket to bring down your interest rate. Usually 1 point is the equivalent of 1% of your loan amount. And generally 1 point will bring down that interest rate about 0.25%. So for some of our clients that really have a certain target budget, they may want to invest that amount of money into bringing down their interest rate. So those are things we look at, but the thing we're trying to make sure makes sense for the buyer is that it's usually about a 2 to 3 year break even mark when we invest in additional costs like that. So especially in today's market, where clients may be considering a refinance down the road, it doesn't always make sense to put a lot of money down into discount points. Okay, so a couple other characteristics in interest rates. Down payment plays a role. So if I put 3% down versus 20%, that'll make a difference. And then finally, the term of my loan will impact my interest rate. Generally, in a normalized market, we'll see a 15-year rate will be a lot lower than 30-year. But in today's rate, today's market, it's really not a difference because there's currently an inverted yield curve that's happening right now where short-term rates are intersecting long-term rates. Okay, quick question came up, and then we're going to dive into credit, which was, can I just give a quick estimate on what are future costs for refinancing? And let me just give a quick explanation on what is refinancing, because many of you might be asking that question. So refinancing is when I decide to take my existing loan and bring down my rate, because ultimately I'm trying to achieve a lower payment. Now, that service of refinancing doesn't come without a charge. So refinancing generally runs anywhere between $3,000 to $3,500 between lender cost, escrow cost, some of the government recording costs. So when we think about refinancing, we want to make sure there's a good benefit for the buyer, meaning I want to have a great enough savings that gives me a good recoup period on that cost investment. So generally, we want our clients to break even in 18 months or less. So meaning I would have to save probably somewhere around $200 a month through a refinance. All right, great question. All right, let's dive into credit. And I want to give you some tips and some resources, give you kind of a little bit of knowledge around, how do we get our credit in the best possible position? Because as you just saw, credit can impact my elected interest rate. So let's first of all talk about what goes into a FICO score calculation. So 15% of the FICO score calculation is how long have I had credit? So the more mature my credit file is, the better my potential credit score could be. 20% is going to be how much credit am I trying to obtain? So am I opening a bunch of new accounts? But then when I open those new accounts, I'm having inquiries on my credit, which will be hard inquiries. Hard inquiries can negatively impact your score. So we want to be careful not to have too many, especially in the most recent 6 to 12 months. All right. 30% is going to be around credit utilization. We have amount owed here, but basically it means credit utilization. So if I'm looking at my revolving accounts, like my credit cards, my personal lines of credit, maybe my overdraft protection, I want to make sure I keep my credit balances at least below 50% of the credit limits. And if I'm really trying to get a maximum credit score, I want to be below 10% of my credit limits. So if I have $10,000 in credit limits, my balances right now are at $8,000. I'm at 80% utilization. So my first effort will be to try to get below 50% utilization. Once I've really accomplished that big goal, then I want to try to get to 10% or below 10% utilization. 35% is going to be how have I paid my bills? So do I have delinquencies? Am I over my limits? What's going on with my credit profile? Usually if you've had late payments, it's going to be in the last 30 day, or they're rated as 30-day lates, 60-day lates, and 90-day delinquencies. If I've had any of those events on my credit report in the most recent 12 to 24 months, it's going to be where it's most impactful for me. Okay. And I got your question in the chat. Yes, we will discuss DTI. That'll be a little bit later and about 3/4 of the way through tonight's class. So DTI is debt to income ratio. So we'll cover that in just a bit. So if we look at loan programs, as you can see on screen, and we're going to talk about programs in just a second, every loan program has a minimum credit score. So as we review different options for our clients, we're going to figure out what the best approach is for you with your product selection. Now, there's other credit score factors to keep in mind. So if you've had maybe a bankruptcy, maybe you've had some collections in the past, those events in the most recent 12 to 24 months are going to be the most impactful to your credit score. Now, let's talk more about credit utilization. So the 30% component here, as you can see on our credit kind of weighting, right? So let me talk to you about how do we best manage credit utilization? So I'm going to give you a couple tips here with that. So if we, as a homework assignment tonight, pull out one of our credit card statements, we look it up and we say, okay, well, here's my due date. First of all, find the due date, and then we want to find the billing cycle end date or statement date. Now, that billing cycle or statement date is the date at which your account closes out, and the data for that period is sent out to the credit bureaus. So if I have a billing cycle date on the 20th of the month, American Express is going to send out my payment information, how I paid, what my balance is, my credit limit out to the credit agencies, over to TransUnion, Experian, and Equifax, right? Now, many of us on tonight's call probably pay off our credit cards or pay them down on the due date. But if we can change that behavior and try to pay them down or pay them off before the end of their cycle date, what that's going to do is going to bring that balance lower on your credit report, and now give you a much more improved credit score because now your utilization report's higher. So it's okay to pay them on your due date, but you're not getting the benefit of lower utilization on your credit score. Okay. Account closures, something we want to just be mindful of. If you're closing revolving accounts and because you're doing balance transfers to a different credit card, just be careful, because that can actually bring down your credit score, because when you close out an account, that actually pulls away all the great data that the agencies have on you and could potentially bring down your credit score. And as we evaluate qualifying options for our clients, we look at all three bureaus, but we take the middle credit score of those three reporting scores. So if my highest score is 760, my middle score is 740, my lowest score is 720, we're going to take 740 for the score to evaluate the client's eligibility. And if I have a partner that I'm going to apply with, now let's say my partner scores are 720, 700, and 680. Well, my partner's middle score is lower than my score, right? So in that case, if we decide to apply together, we would take the 700 score, and that's what would be evaluated for qualifying purposes. But also, it could impact your eligible interest rate. Okay, now if you've had some past challenges on credit, here's a matrix to help you better understand how long are these things going to stay with us on our credit report. Now, they're probably only going to only impact us for the most recent 12 to 24 months from the event, but this is how long they'll actually stay on the report. So I had a client that talked to us today, has a bankruptcy, Chapter 13 bankruptcy, and wanted to know how long that would stay on their credit report. Well, that would be on there for 10 years. Now, would it impact them for 10 years on their credit report? Not really. It's going to be really the most 2 years from the date of the filing, and then they'll have to obviously improve their credit over the course of time. Okay. All right. So when we look at credit and we're evaluating options for clients, generally student loans will come up as an obligation for most buyers, right? And as we know, student loans are in repayment as of last month. So if you're in an income-based repayment amount, you probably have a minimum payment that you've already started paying on. If you're still in school or doing some post-grad work, whatever the case may be, your loans are probably in deferment. At the end of the day, if we're thinking about purchasing a home, regardless if we're in deferment, forbearance, or we're in active repayment, we do have to count a minimum payment for qualifying purposes. And so what that looks like, if I have, let's say, an income-based repayment amount, and that's what I'm actively paying, we can use that amount for qualifying purposes. So let's say I owe $75,000 in student loans right now, and I'm on a $250 income-based repayment amount. That $250 is what we can use for qualifying purposes. Some cases we have clients that have a zero payment and that's their payment agreement. That still can be used for qualifying. Now, if you don't have a payment arrangement set up and maybe you're still in school, but you really want to apply for your home financing because maybe you're going to night school, but you still have your active employment. That's what you plan on, utilizing for your income source for purchasing. In that case, when you don't have an active payment plan, we would use 0.5% of the balances on an FHA loan as your monthly payment to count towards qualifying, or 1% for a conventional loan. So those are things that will help you navigate as we look at qualifying options for you, but something just for you to kind of understand on how student loans are viewed in qualifying. So forbearances, deferments still have to count a minimum payment for you in qualifying. And some of our clients that have just graduated, even during the pandemic, haven't started repayment yet. So those are things we'll kind of help coach you through as we look at different options for your home financing. Okay, let's talk a little bit about loan programs. And in our classes, we like to kind of cover the 5 core programs that are offered to buyers as different solutions for your home purchase. So I'm going to kind of give you a little bit of a high level look at each one of these products. And you may have heard some of this terminology in the past. And so we'll kind of connect the dots with that. So with a conventional loan, that's for a Fannie Mae and Freddie Mac loan. So generally, Fannie Mae and Freddie Mac loans have a minimum down payment of 3%. When we rise above a loan amount of $726,200, our down payment will elevate from 3% to 5%. And in areas, high cost of living areas, most of which are in California, you can go up to a loan amount of $1,089,300 and still get financing under Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac have about 60 to 70% of all originations across the country. It's a minimum credit score of 620 on the conventional loan product. And, obviously that's more of the appealing option for most of our first-time buyers. For FHA loans, I have a minimum credit score of 580, same loan amount parameters. So I can go up to 726,300. I can also stretch that to $1,089,300 in some of those similar high cost of living areas. But with FHA loans, the minimum down payment still remains at 3.5%, regardless of what loan level I'm at. And then for our veterans that have served that have VA eligibility, it's a 0 down payment option up to $1 million or beyond, depending on the market they're looking to purchase in. The VA product's an amazing product to help support our veterans. What we find with the VA product, a little bit more leniency to help our veterans access home ownership, credit scores down to a minimum credit score of 620. All right, so the last 2 products are our USDA product and the jumbo loan. The USDA loan is going to be for more of our clients that want to purchase in kind of rural areas. Maybe you wanted to really buy a house in Joshua Tree, right? Well, that's considered a rural area. It's defined, or the guidelines have, a location that's defined as rural. And there's also income requirements on the USDA product. So it looks at the household size, and then you can't have a certain amount of income based upon that area where you want to purchase. And then we have jumbo loans. Those are going to be for our clients that need a little bit more financing. So those clients will generally need to be purchasing above $1,089,300 in some of our high cost of living areas. If you're in Santa Barbara, for example, then you're purchasing above $805. The down payment is a bit higher than your standard product. So it's usually 10 to 15% down. So when we think about savings for our home, we have to carve out savings for down payment. We have closing costs. But with jumbo loans, there's an added asset layer, and it's called reserves. Reserves are taking into consideration available assets that you have after you've contributed those assets for down payment and closing costs. Usually the reserve requirement is 12 months of your monthly payment. So if I have a $7,000 mortgage payment times 12, I would need an additional $84,000 in assets. Okay, that's a kind of a quick high-level look at loan product programs. I want to dive a little bit deeper though in terms of looking at PMI. So you guys may have heard about PMI or private mortgage insurance that comes into play when we put less than 20% down to purchase a home. And so what I want to do right now is kind of do a side-by-side comparison on a conventional loan versus what it could look like on an FHA loan. But let's kind of first understand the different payment options that come along with a conventional loan. So you can actually pay mortgage insurance in a variety of different ways. It can be done monthly. You can split that up between your monthly payment and then a upfront payment. You can pay it completely out of pocket upfront, not a big or popular option. You can also do what we call lender paid mortgage insurance, where you're taking a higher interest rate in lieu of paying off your PMI entirety. Now, PMI is based upon a few key factors on a conventional loan. It's based upon your credit score, how much you decide to finance, and what your down payment is. What we find often in counseling with clients is that a lot of clients that begin their searches on like Redfin or Zillow don't have an accurate representation of PMI because a lot of those calculators on those sites just aren't calibrated based upon those criteria. Okay, so when we do the math, and we're gonna show you an example in just a second, what we find is PMI is a lot lower than what clients have an expectation of. And then with PMI on a conventional loan, you do have a cancellation option where once you have 2 years in your loan and you have 20 to 22% equity, you can apply to have mortgage insurance potentially canceled. And then when we look at the conventional mortgage insurance option, let's say we finance $700,000, right? And we're going to put a minimum of 3% down and we have a credit score of 740. The mortgage insurance is about 209 per month. So pretty reasonable considering. And like I said, when you look at other calculators online, that may be as high as $300 or $400 a month. So a little bit more reasonable when we consider credit score and how much our down payment is. Now, the higher we can bring our credit score up, the better or more improved our premium cost will be for PMI. Now let's look at FHA mortgage insurance. There's two forms of PMI on mortgage insurance. There's on FHA loans. There's a monthly mortgage insurance, which is 0.55% of the overall loan amount. And then FHA also adds on upfront mortgage insurance, which is 1.75% of the loan amount. And that gets added into your amount finance. FHA loans do not have a cancellation option. So the only way to basically get rid of mortgage insurance is I would have to refinance out of that FHA loan into, say, some type of conventional loan product. And then when we look at the example of FHA PMI, now FHA just recently, not recently, but in the last 3 months made some enhancements to the premium for FHA mortgage insurance, bringing it down by 0.30%. When we look at an amount finance still at 700,000, our PMI is about $320 a month for FHA, but we do have to add on 1.75% of this loan amount in the form of upfront mortgage insurance. So that would increase our total borrowing costs per se. Now, you may step back and look at these two scenarios and say, wow, why would I ever choose FHA? And, there's definitely reasons why one buyer would go with one product or the other. But when we think about these two different products, they do have different requirements, different guidelines. FHA tends to be a little bit more lenient. Maybe I had a past late payment on a student loan. Conventional might have, some challenges with that. Maybe I had a bankruptcy 3 years ago on an FHA would be okay, but on a conventional loan, I would need 4 years. So it depends on what the right product fit is for you. And of course, as we walk clients through a consultation, we figure out kind of what's the best path to go down when it comes to product selection. All right. All right. Well, let's kind of keep moving. We're going to talk a little bit about employment and documentation generally needed on the income side of things. And we'll kind of go through this section relatively quick, but I know we have the question around debt to income ratio. So we're going to get to that in this section. First of all, let's talk a little bit about what's required from a documentation perspective. So as we're willing to take or proceeding with home ownership, the documents that we'll generally need is the last 2 years of W-2s. We'll need the last 30 days of pay stubs, and then we're going to verify your employment, generally through a written means as well as a verbal verification. Now, if I'm self-employed, it might be a little bit more documentation. We generally have to have the last 2 years of tax returns. We'll need a profit and loss statement, probably a balance sheet, and then we'll need a CPA probably to verify how long you've been in business and the health or financial health of the overall business. So that's generally the documentation we'll need, but let's talk more about like what are the general requirements around employment, because we do get some I guess, misrepresentation, or buyers get some misrepresentation of what's really needed to qualify on a mortgage. Because a lot of clients think they need 2 years on their job to qualify for a mortgage, which just really isn't the case. So let me give you an example. So if I graduated from UCSB with a 4-year degree, right? I said 4 years undergrad, but now I just recently started my job. And let's say it's in the accounting field, right? If I have my 4 years education and I just started my job, that 4 years would actually satisfy the 2-year requirement for basically potentially purchasing a home and the financing requirements. So I just need to have 2 years between my employment and or my education. Now, let's say I've just recently started my job, or maybe say I have a job that I've been on for maybe a year, right? And I'm going to switch jobs and start a new job. If I want to consider my new source of income, that can be potentially considered as long as I have my offer letter showing what my new income is going to look like. So that's another kind of a misconception that we have or in the marketplace, is that I have to be on my job for a certain amount of time. Now, if I have dual employment, so let's say I'm in the healthcare industry and I work for 2 different clinics, right? If I'm working for one clinic for 30 hours a week, another one for 20 hours a week, I do have to show that I've been on both jobs for 2 years simultaneously in order for both sources of income to be considered for my qualifying. Okay. Now, if I'm self-employed, as you can see, the documentation is a little bit more intensive. Being self-employed, we do have to have at least 2 years self-employment for me to consider that income. Same thing holds true where, let's say I have a job where I work a 40-hour work week job, but on the weekends, I like to drive for Uber, but I want to consider my Uber income. In order to consider that Uber income, I have to show that I've been able to demonstrate working my 40-hour work week job plus the 2 years of, contract employment, which essentially what Uber employment would be, right? Now, if I have additional sources of income, so let's say I'm currently, renting room, I have a roommate, right? And I want to conclude the rental income that I receive from my roommate towards qualifying. That, unfortunately, for the most part, cannot be factored into the new income I'm using to qualify for my mortgage. If I have a partner that's not going to be a part of my application, but I really want to use my partner's income to help me qualify, the only way that income can be considered is if we apply jointly on our application. All right. Okay, so let's now talk about debt to income ratio. And so what debt to income ratio is, it's your gross monthly income, so your pre-tax income versus your monthly obligations. So when we think about monthly obligations, those are going to be like personal loans, student loans, credit cards, auto payments, as well as my new housing expense. And when we think about this calculation, usually we don't want our expenses to be more than 43 to 45% of that pre-tax income. This is a calculation we use for qualifying, but doesn't generally, well, it doesn't indicate affordability. When we think about affordability, and that's one of our big goals for homeownership for our buyers, we're going to be talking through a budget analysis, because our 2 big goals are affordability, and we want to have it be a sustainable plan for homeownership. The debt to income ratio is going to measure what our qualifying looks like, right? So here's what the formula looks like. So we're going to take into consideration our principal, interest, taxes, and insurance for our new housing payment. We're going to, if we're putting less than 20% down, have PMI, so private mortgage insurance, which we just learned about. If I'm buying a condo, maybe a townhouse, I'm going to have HOA fees or homeowners association dues. So let's say that monthly amount's $2,500, right? And then I have my other payments. I have a car loan and maybe a credit card. So that totals $500 a month. So if I took my $3,000 in expenses versus my $8,500 a month, my debt to income ratio lands at 35.29%. So one of the questions I get often in teaching our classes across the country is like, where should my debt to income ratio be? And, it varies for every client that we serve. Most of my first time buyers feel comfortable around 33 to 36%, but, some clients feel, comfortable closer to 43, 45%. Especially if there's some additional income that we're not factoring into the equation. But, it's our job to kind of design a home buying plan that makes most sense for all of our clients in their journey towards home ownership. Okay, hopefully I answered your question on DTI, but if I missed anything or want me to kind of recap that or go back to it, I'm more than happy to do that. All right, our next stop in kind of this home buying plan in our tonight's class is going to be around discussing assets or savings for my home purchase. There's usually two kind of hurdles to home ownership, if you will. That could be credit, just because maybe I have a little bit more debt out there than I'd like to be, or maybe I've had some past credit challenges, or I just haven't saved enough for my home purchase. And so we're going to talk a little bit about savings and the documentation for that. And then we're going to dive into first-time homebuyer programs, which can help support you from an overall kind of resource towards your out-of-pocket expense to purchase a home. So let's first talk about the documentation needed. So generally, we're going to need the last 60 days of statements for your checking and savings account. There can't be any cash deposits. Those can't be used in a home purchase. You can potentially use 401ks, 403bs, even IRA accounts. I would encourage you to talk to your tax or financial advisor before you dip into those assets, because we don't want to create like a tax event for yourself. Potentially gift funds can be used for a home purchase. That's where a family member is helping support you with your home purchase. With gift funds, we don't have a 60-day requirement, whereas with your own assets, they will need to be at least seasoned 60 days. So the process for gift funds generally will include a gift letter that will be completed by the donor, and then we would need to verify the asset through like one of their asset statements, but it doesn't necessarily have to have any type of seasoning requirement. Now, with assets, we want to document all those assets. You can contribute as much as you want in assets. But, for some of our first-time buyers, the challenge of saving enough, especially in today's kind of high cost of living market, can be very difficult, especially when we want to make homeownership a near-term goal. Because, when I meet with clients, some clients, are looking at 3-5 years out based upon their initial savings. But as we meet with clients and develop home buying plans, potentially with assistance programs, they can make homeownership more of maybe a near-term goal, like maybe in the next few months or the next year. And so the state of California has a housing division called CalHFA, the California Housing Finance Agency, and we get a chance to partner with them. And we're very fortunate. We're actually the #1 lender for CalHFA. So we're really passionate about supporting low to moderate income homeownership in California. We understand the challenges that come along with homeownership or getting to homeownership. So we obviously have partnered with CalHFA to be able to provide these products to the marketplace. So we're going to spend some time now looking at first-time homebuyer programs and kind of get a chance to give you a sense of what resources are out there for you in California. Now, you may not be joining us from California, and that's okay, because there's various agencies across the country that can help support you in first-time homeownership. So after tonight's class, if you're in a different, a state, get connected with us and we'll get you the right resources you need for first-time homeownership. But we're going to talk specifically now about California programs. I did see your question in the chat, so I'll answer that real quick, which is, are there any specific programs available for educators, or are they no longer in existence? So right now, there is no specific educator programs that are out there. The programs that are offered through CalHFA, through the state agency, are kind of more of just, they're all inclusive, so they're not for specific occupations. All right, so let's talk about CalHFA and some of the products that are offered. We're going to talk about 2 products that are active in the market right now. Another program that's coming in spring of 2024, you may have heard about it. We successfully launched the first wave of California Dream for All earlier this year. There's going to be another wave of it next year. But let's talk about the existing programs right now. So CalHFA offers a My Home Assistance program, which provides 3% of your sales price in assistance for a conventional loan and 3.5% of your sales price for an FHA loan. So if we were kind of look back to our product analysis we did earlier, the minimum down payment for conventional is 3%, 3.5% for FHA. So the My Home Assistance would fill the void for those minimum down payment requirements. What My Home Assistance is, it's a 1% simple interest rate loan that you don't have to pay back to the state until you either decide to sell the home or if you refinance in the future. So it's a complete deferred payment, and it's only at a 1% simple interest rate loan. The next product is a 0 interest program. It's called ZIP. And what it does is it allows you to get an additional 2% of your loan amount to help support you with closing cost resources. It's a 0% loan, same deferred option as the My Home Assistance, does not need to be paid back until you either sell the home or if you refinance in the future. Now, the way the product selection works is you would have to take My Home first, And then if you do need additional resources, then you can add on the ZIP assistance program. But in today's market right now, the ZIP assistance program will elevate the first mortgage rate. So we generally don't recommend that in today's market. Now, if the market starts to kind of come down and from an interest perspective, then that ZIP assistance may make a little bit more sense. But right now it's a bit limited just to because of today's current market rates. And then the California Dream for All shared appreciation loan. We're going to spend some time talking about that in just a second. What that program is, it's a shared appreciation loan for select borrowers in the state of California, up to 20% or $150,000 of the sales price. Now, whichever is less. So 20% of the sales price or $150,000, whichever is less. The guidelines of that program will not be launched until January, but we'll give you kind of a what we know so far with the proposed guidelines with that program. If we look at applying for the My Home Assistance Program, just a couple benefits just to take away from this program. Not only is it going to provide you up to 3% of your sales price in assistance at a 1% interest rate, the rates tend to be a little bit lower on first-time buyer programs. Generally, they're about 0.25% lower than the market. So today's offered rates for Cal HFA was 7.375 versus the standard market rates, probably closer to 7.5 to 7.6%. So if we look at a conventional loan right now, let's say we decide to purchase at $700,000, the minimum down payment is 3%, right? So $21,000. If I factor in what I need to save for my down payment plus my closing costs, and generally we recommend buyers to budget 2 to 3% of their sales price for closing costs. So let's say that's $14,000 to $21,000, right? So I'm probably going to need $35,000 to $42,000 to purchase my home. Well, most of our first-time buyers don't have access to those assets. At least 60 to 70% do not have those assets. So where the first-time buyer solution can come in is that 3% My Home Assistance can help offset what you need to save for your minimum down payment. And then you do have the option, if it makes sense, to add the ZIP assistance program in to augment some of the closing costs. But ultimately what we're doing is, at worst case scenario, being able to now take that out-of-pocket expense, instead of being $35,000 to $42,000, now reducing that maybe to $14,000 to $21,000, which could be much more manageable, especially for a first-time buyer trying to pursue home ownership. Now, there are eligibility requirements on the Cal HFA assistance program. Usually it requires a minimum credit score of 640 for an FHA loan, 660 to 680 for a conventional product. And the debt to income ratio that we learned about a little bit earlier, maximum of 45 to 50%. One of the great things about Cal HFA, beyond all the perks of assistance and lower interest rates, is the income qualifications tend to be a little bit higher than most first-time buyer programs. So Cal HFA is set at 150% of the median income, which just makes it more inclusive of a program to get more first-time buyers into home ownership. There's opportunities to be able to apply for this program if I have dual income and only consider one source of income. So here's what I mean by that. When we show you the income limits in just a bit, let's say I have $150,000 in income that I make, but my partner makes $150,000 as well. Well, maybe combined, we exceed the income limits for the program, but I could potentially qualify in just my income, and then we could potentially have participation in the program. Now, a first-time buyer on this program is someone that hasn't owned in the last 3 years. So I may have owned back in 2015, since sold, been renting them for the last 3 years. Now I'm still considered a first-time buyer. And this is eligible for one-unit properties, which would include like a single-family home, condo, townhouse, sometimes manufactured homes, as long as it's on land that we own on that manufactured home. Here's the income limits for the program. We kind of gave you more of a Santa Barbara, greater Santa Barbara area out to the the Bakersfield area. Look at the income limits stretching down into the Los Angeles as well. So these income limits are updated every July by the state of California. And so, we'll see some adjustments later in 2024. Now, really quick, I just want to just comment really quickly on the California Dream for All program before we move into the process. So you may have heard about the California Dream for All program. We're going to be sharing information as we receive that from the state. We're expecting guidelines to officially be available in January. So we'd encourage you to stay connected with us. If you've heard some talk around that program, There are guidelines that are going to be implemented in January. Some of the early indications will be the income limits will be a little bit lower than what we've seen in the first California Dream for All, which will be 120% of the median income. And there are some first generation homebuyer requirements with the program. And the program's probably going to be based upon a lottery system. So we'd encourage you to stay tuned for more details as we receive those from Cal HFA, but that should be rolled out in January for the guidelines, and we're expecting a potential launch in March for April. All right, let's talk a little bit about the process of purchasing a home, because after attending tonight's class, you may say, wow, Jason, where do I go from here? Like, this sounds all really great and stuff, and I think I like to set some goals of home ownership, but where do I start, right? So this is our 6 steps of home buying. And leaving tonight's class, we would encourage you get connected with us for a consultation. It's a free service we provide. So whether your goal is, I'm buying next year, I'm buying in 2026, at least you'll have all the tools and resources to help you on that path towards home ownership. And the first step, in which really is the output of a consultation with us, is to get pre-approved. Now, there's always options to do automated pre-approvals through lenders and whatnot, but we kind of take this really as a big, serious first step, right? Because it's a consultation. We want to help design options for you. And that's about a 30-minute session during that consultation. Then the output of that consultation is to be pre-approved. The pre-approval is good for 60 days, but it's something that we can always recertify at any time. You know, we've had buyers that have been shopping for the last 2 and 3 years. We can always recertify that pre-approval at any time. So there's no rush to go out and buy. At least allows you to be able to kind of have a baseline for home ownership. Really quick, I had a question in the chat about where do I sign up for a consultation? We're gonna show you all the links for that as we get wrapped up in tonight's session. So we'll definitely get that for you. So thanks for that question. So step 1 is going to be the pre-approval output of the consultation. Now, where do we go from step 2? Well, that's the fun part. We get a chance to start looking at homes. Now, you've probably done some of your searching online, which is generally where most buyers start their search. Now, once you've kind of seen some properties that really kind of pique your interest, then you'll probably physically start to go out and look at properties. Now, we would encourage you get connected with a realtor. They're probably going to be an expert in their market. We have a fantastic network of preferred realtors. If you want us to get you connected with one of those, we'd love to be able to do it. And as you go through step 2 in the house hunting, you may need adjustments to your pre-approval. So you may get pre-approved at $700,000. But hopefully you find a house for $650,000. So we can always adjust down that pre-approval for you based upon kind of what you're seeing in the marketplace. Well, let's fast forward a little bit. Let's say I find a house, I love it, I place an offer on a home, and guess what? The offer gets accepted. Now, you have to forewarn everyone, you're probably not going to have an accepted offer on your first submission, but let's, fingers crossed it does happen. But, it may take 1 or 2, maybe 3 offers to be able to have a successful, acceptance by a seller. But let's say that does happen, right? And we have an accepted offer. Well, that moves us to step 3. That means we're now entering escrow. So now you have a ratified agreement with the seller, and we start this process. Usually from step 3 to step 6, it's about 30 days. So to go from accepted offer to getting the keys to my house, 30 days. Now, once you have that accepted offer, we're going to reach out to you, say congratulations, talk to you a little bit about next steps in the process, and schedule you for your follow-up video consultation. So very similar to the initial consultation, but in the follow-up, we're going to dive a little bit deeper on the contract, what you've agreed to with the seller, your options for your product, and have a good plan to take us from step 3 to step 6. Now, we also start things like getting your house appraised at that time. You as a buyer will be responsible for making what we call is an earnest money deposit. And what the earnest money deposit is, it's your good faith investment in the transaction. It's usually 1 to 2% of your purchase price, and that will need to be deposited within the first 2 to 3 days of your contract. Now, that deposit is held in escrow through what we call is the contingency periods. And the contingencies allow you to do your investigative work on the property, get the house appraised, get the house inspected, of course, get your loan approved. That all happens generally in the first 14 to 17 days of your contract. Now, it's a very competitive market out there right now, believe it or not. So even though interest rates are at the 7-ish level right now, there's still a lot of buyers out in the market. So it's very unlikely that when I make an offer on a house that I'm not going to have 2 or 3 other families that really love the same house, right? So, there are ways to help make our offer more competitive. We can shrink those contingencies down to a shorter period of time. At times, we have a shorter close of escrow time period. So instead of it being 30 days, maybe we can bring it down to as short as 14 days. So we can accelerate some of those timelines to help position our buyers for the highest success rate, right? So step 4 is going to be processing and underwriting of your loan. Those are the administrative things that we do on your loan. That also includes, ordering the appraisal of your property. By that time, we probably also have your interest rate locked. When an interest rate is locked, that means whatever that rate selection is, that rate is protected against market volatility. So if you lock your rate at, let's say, 7.25, rates overnight go up to 7.75, you as a consumer are protected against that upside in the market. Step 5 is going to be loan approval. So that's where your loan has been underwritten by an underwriter that's reviewed your income, your assets, your credit, the property to make sure this is a sound investment for you. We issue your loan approval for you, and that's usually done within a week to 2 weeks of the acceptance of the offer. That's also going to bring you to the end of that contingency period, that investigative period, right? So if you've gotten your appraisal back, the value is supporting the purchase price, you've done your inspections, you feel good about it, and you have your loan approval, then you can release your contingencies to the property. Now, you just want to be aware as a buyer that once you release contingencies, and let's say you decide to cancel after you release your contingencies, you could risk losing your deposits. We want to make sure that we feel really good before we release those contingencies. The last thing that happens in step 5 is, as your lender, we're going to issue to you your final closing disclosure, and that issues a 3-day cooling off period for you. So that allows you to make sure that the final disclosure that you get at step 5 matches up to what you expect as a buyer. And there shouldn't be any surprises when you get that disclosure, because it's going to map to everything you've received in the past. Now, all disclosures are done via e-signature, but when we get to step 6, there's in-person documents that need to be completed, and they're actually completed with a public notary. That process of signing your final documents at step 6 usually takes about an hour or so. At that stage, you're going to go through all the final terms of your loan. You're also going to be responsible for wiring or providing a cashier's check for the final funds that you need for your transaction. And then as a lender, we're going to wire in the final funds for the mortgage. Those funds are all accounted for by an escrow team to make sure you've contributed what you're supposed to. After that's done, documents get recorded with the county recorder's office. So if I'm, purchasing a home, they're going to record a grant deed to transfer ownership to us, and they're going to record a deed of trust, which is your agreement to repay the loan. And once we get the confirmation back from the recorder's office that everything's all recorded, then I get a chance to make my favorite call of the day, which is to call our new buyers and say, guess what? We did it. We got to the finish line. You're now a homeowner. Go get your keys, go take your selfie in front of your house. I mean, you did it. You're now a homeowner. And that's like the best part of my day, because, it doesn't come with, concern or, anxiety of going through this process, because it's a big deal. Like I said earlier, it's probably going to be the biggest investment you make in your upcoming financial futures. But, we want to be a partner with you, helping you navigate the waters of this process. Now, we had a question in the chat, which is like, if I'm ready to take the next steps in home ownership, what does that look like for me? How do I get connected with you guys for a consultation? Here's our information to begin the process. So the consultation starts with a really simple online application. Another question we had in the chat was, is it a soft credit check? So yes. So we only start with a soft credit check because we really don't know when you're going to decide to buy, right? We don't want to put a hard inquiry on your credit report. You may decide to purchase now. You may decide to wait for the next couple of years, but we want to use that credit to be able to help kind of give you some credit coaching if there's areas of opportunity for you. And then you'll upload proof of your income, your assets. And then after that's done, you'll schedule a video consultation with us. And that's where you and I get a chance to do a one-on-one and design product options for you. Now, you may have some questions after tonight's class, and maybe it's just a scenario you want to run by us, or maybe kind of talk more about some of the products we shared with you. We'd encourage you to get connected with us for a quick 10 to 15 minute introductory call. Here's how that free consultation works. And by the way, this consultation is a free service, so there is no pressure to purchase. We just want to help further educate you on what your options might look like. There is, it's a free service to help kind of design home financing for you. So, we'll talk about, where I want to purchase, what the price I'm looking at, how much I have saved, what do my savings goals need to look like? Am I in the right position from a credit perspective? All those things will be outlined in our consultation. Now, In processing and helping clients for home buying, we leverage technology. We're a big believer of technology, but we also want to be there to help support you during this journey. But our mobile tool can help kind of start that journey for you. You can start the application right from mobile. You can follow the processing of your loan through those 6 steps that I shared with you earlier. You can also run calculations. So as you're out searching for homes, you can run different payment scenarios for you on a particular home you might be interested in. Okay. And it's not just about technology, because this is going to be, like I said, a big purchase for you. So we want to make sure we're always accessible for you, whether that's via email, text, call. We want to make sure you get all the questions that are answered in a timely time period, to make sure that you have all the resources you need. Now, we're excited about our UCSB partnership. I'm thrilled to be able to bring this first workshop to our community, and hopefully you've enjoyed tonight's content. As I mentioned earlier, as a UCSB alum, you get participation in our discounted program. So we do discount our origination charges to help support you. So once you get on that path towards homeownership, we want to provide all of our education tools and discounts to help better support you. Thank you so much for attending tonight's class. If you do have questions after tonight's class, we'd love to get connected with you. So here's all my information here. So whether that's through an introductory call or a consultation, we have different means for you to get connected with us. We'd also encourage you to follow us on our Instagram. We try to put out really good content for our first-time buyers because we understand the questions that you're going to have in this path towards homeownership. So we want to make sure you're always getting great resources out there. And all of our classes that we've taught over the last 8 years can be found on our YouTube channel. And we'll be teaching other live classes available. So as different products come out, especially in California, we'll be hosting live YouTube Q&A questions for our local communities as well, too. So with that said, I'm bringing us to the end of tonight's class, and I do want to open it up for Q&A. I think we got some few questions hopping in the chat, so I will answer those on air, and then we'll just wrap up tonight's session. So the first question was, is this being recorded tonight? So yes, it is. And so we'll provide you the recorded link tomorrow morning, as well as all of tonight's presentation material. All right. Any other questions from our audience out there? Hopefully I didn't miss anything in the chat there. Okay. Any other questions from our audience? Okay, question is, what is the discount for? So the discount is just part of our partnership with UCSB. So in setting up our strategic partnership, we want to bring additional value beyond our workshops to you. So normally we charge a $910 processing fee when someone procures financing. So when someone closes a loan, that gets dropped down to $160 as part of our UCSB partnership. All right, so let me answer this question. So the next one is, if I'm interested in finding a piece of land and building a small house, do you offer financing for this? Is it worth doing a consultation to discuss further? So land acquisition's a little bit tricky. Unfortunately, we don't offer land financing. I would encourage you to get connected with maybe your local credit union. Land purchases are a little bit difficult for kind of traditional lenders such as ourselves. Most land purchases are going to require you to put at least 50% down, but I would encourage you maybe talk to your local credit union and see if they have any options for you. So question was, when I use kind of the word partner, do you have to be married or just together to get a house, and then pick the credit score to use? Okay, so good question. So this question comes up often. Do I have to be married to apply jointly? So no, not at all. So when we think about partner, you don't have to have any type of domestic relationship in applying together. It's just whether I'm applying with my brother or I'm applying with my partner. We're always going to look at the lowest middle score between both borrowers. Okay, so it doesn't have to have any type of relationship. It can be a familial relationship or a domestic partner relationship. The next question was, can I kind of expand a little bit more on renovation loans? So what renovation loans do, or they allow you to do as a buyer, is to purchase a home at a certain price and then be able to leverage financing to be able to help improve that property. So generally, they're going to be offered under what we call 203K loans. It's under the FHA suite of products. There's two different kind of lanes you can go down with 203K. There's a streamlined product, which is anything below $35,000 in improvements. and there's a full 203K. And so which is a little bit more complicated and requires a few more restrictions. But in essence, what it's doing is allowing you to get additional financing for improvements to the home. And that financing is based upon the future kind of replacement value of that property. All right, great question. All right, any questions? Any other questions from class? All right, you're welcome. Thank you. All right, very good. Well, I think we're good on questions. I want to thank Samantha for getting us kicked off tonight. Again, we couldn't be more thrilled to be able to and grateful really to partner with UCSB in delivering homebuyer education to our local communities. And if you have any questions after tonight's class that didn't get answered, feel free to get connected with us. We'd love to be able to be that partner for you in homeownership. Enjoy the rest of your Wednesday evening, and we look forward to connecting with you soon. Good night.